Investing for beginners, where to put your first $1,000. Hey everyone, welcome back to A Momentum Money. If you're new here, we're all about building wealth through smart money strategies and powerful habits, so make sure you hit that subscribe button. Today, we're tackling something that I know intimidates a lot of people, investing. Specifically, you've done the hard part. You saved your first $1,000. Maybe it took you months, maybe it took you a year, but it's sitting in your bank account right now, and you're wondering thing. That money sitting in a regular savings account is actually losing value every single day due to inflation. Your money should be working as hard as you do, and that's exactly what we're going to talk about today. I'm going to break down the exact investment vehicles you should consider, the risk levels of each, and how to choose based on your personal goals and timeline. No confusing jargon, no overwhelming you with information, just clear, actionable steps you can take this week. Let's get into it. Before we talk about where to put your money, we need to talk about three things first. Think of these as your investing foundation. First, emergency fund. Before you invest a single dollar, you need to ask yourself, do I have at least 1 month of expenses saved in a regular savings account? Because investing means your money is tied up in my fluctuating value. If your car breaks down next week, you can't just pull money out of investments without potentially losing money or paying penalties. So if you don't have any emergency cushion yet, take that $1,000 and put it in a high-yield savings account first. Build up to at least 1 month of expenses, ideally 3 to 6 months. Then come back to investing. Second, high interest debt. If you have credit card debt earning loans with an interest rate above 7 or 8%, you're better off paying that down first. Here's why. If your credit card charges you 20% interest, paying that off is like getting a guaranteed 20% return on your money. No investment can promise you that. So tackle high interest debt before investing. Third, your timeline. This is huge. Ask yourself, when do I need this money back? If you might need it within the next year or two. Investing in the stock market isn't the right move because markets can be volatile in the short term. But if you're looking at 5 years or longer, that's when investing really starts to make sense. Okay, assuming you've got those three things sorted, let's talk about where to actually put that first $1,000. Let's start with the simplest and safest option, a high-yield savings account or money market account. I know what you're thinking. That's not really investing, and you're kind of right, but hear me out. If you're still building confidence, if the idea of the stock market terrifies you, or if you might need this money in the next year or two, this is actually a smart move. A high-yield savings accounts right now are offering somewhere between 4 and 5% interest. That's way better than the 0.01% you're getting at a traditional bank. Money is completely safe, it's FDIC insured up to $250,000, and you can access it anytime. The downside, 4 to 5% isn't going to build serious wealth. It'll barely keep up with inflation, but it's a starting point, and starting is better than staying paralyzed by fear. Now let's talk about what most people think of when they hear investing. The stock market. Here's the beautiful thing about investing today versus 20 years ago. You don't need thousands of dollars or a fancy broker. You can start with literally whatever you have, even that $1,000. For beginners, the absolute best place to start is something called index fund. Let me explain what this is without the jargon. Instead of trying to pick individual stocks like Apple or Tesla, an index fund lets you buy a tiny piece of hundreds or even thousands of companies all at once. It's like buying the entire market instead of betting on just one player. The most popular one is called the S&P 500 Index Fund. This tracks the 500 largest companies in America. We're talking Apple, Microsoft, Amazon, Google, all of them bundled together. Historically, the S&P 500 has returned about 10% per year on average over the long term. Some years it's up 30%, some years it's down 20%, but over time it trends upward. The reason I love index funds for beginners is simple. You're not trying to outsmart the market. You're not picking stocks based on random tips. You're just investing in the overall growth of the economy. It's diversified, it's low cost, and it requires almost zero knowledge to get started. You can buy index funds through apps like Vanguard, Charles, Schwab, or even beginner-friendly platforms like Robinhood or Webull. Look for funds with low expense ratios, ideally under 0.2%. That's the annual fee they charge to manage the fund. If you put that $1,000 into an S&P 500 index fund and left it alone for 10 years, assuming that historical 10% average, you'd have about $2,600. If you left it for 20 years, over $6,700. And that's without adding another penny. That's the power of compound growth. Now, some of you might be wondering about individual stocks. Should I buy shares of specific companies? Here's my take. If you're a true beginner, I'd say wait on this. Individual stocks are way riskier because you're betting on one company's success. If that company fails, your money could disappear. With an index fund, if one company tanks, you've got hundreds of others balancing it out. That said, if you really want to dip your toes into individual stocks, here's my rule: only invest money you can afford to lose, and don't put more than 10 to 20% of your total investment into individual picks. The rest stay in index funds. Think of individual stocks as the spicy part of your portfolio, not the main course. Let's talk about another option that's often overlooked: a Roth IRA. A Roth IRA isn't technically an investment itself. It's an account type, like a special container for your investments. But here's why it's amazing. You put money in after taxes, it grows completely tax-free, and when you retire, you can take it all out without paying a penny in taxes. For 2025, you can contribute up to $7,000 per year if you're under 50. So your entire $1,000 could go into a Roth IRA, and then inside that account, you'd invest it in something like an index fund. The catch is that this money is meant for retirement. If you take it out before age 59 and a half, you'll pay penalties on the earnings. But here's a little known fact: you can actually withdraw your contributions at any time without penalties. So if you put in $1,000 and it grows to $1,500, you can pull out that original $1,000 anytime penalty-free. The $500 in growth would need to stay until retirement. If you're young and you're thinking long-term, a Roth IRA is one of the smartest moves you can make. That tax-free growth over decades is absolutely massive. Here's another option that's a bit different: target date funds. These are perfect if you want to be completely hands-off. Basically, you pick a fund based on when you plan to retire. So if you're in your 20s and plan to retire around 2060, you'd choose a Target 2060 fund. The fund automatically adjusts over time. When you're young, it invests more aggressively in stocks. As you get closer to retirement, it gradually shifts to safer investments like bonds. You literally set it and forget it. The downside is that these funds usually have slightly higher fees than plain index funds. But for true beginners who don't want to think about rebalancing or adjusting their portfolio, it's worth it. Now let's talk about something a bit more advanced but still accessible: exchange-traded funds. ETFs are similar to index funds, but they trade like stocks, meaning you can buy and sell them throughout the day. Index funds, on the other hand, only price once per day after the market closes. For most beginners, this difference doesn't really matter, but ETFs often have even lower fees than index funds, and they give you more flexibility. Popular ETFs include VU or SPY, which both track the S&P 500, or VT, which tracks the entire stock market. You can buy ETFs through the same apps I mentioned earlier. Just search for the ticker symbol and hit buy. With $1,000, you could buy a few shares depending on the price. Okay, so you might be thinking, this all sounds great, but which one do I actually choose? Let me give you a decision framework based on your situation. If you're nervous about investing and want to start super safe, put your $1,000 in a high-yield savings account. Get comfortable seeing that money grow, even slowly, and then graduate to investing once you're ready. If you want to invest for the long term but you're overwhelmed, open a Roth IRA and put everything into a target date fund. Literally 2 decisions and you're done. If you're comfortable with a bit of learning and want the best long-term growth, open a Roth IRA or a regular brokerage account and invest in an S&P 500 index fund or ETF. This is my personal recommendation for most beginners. If you already have retirement accounts for work or you just want a taxable investment account, skip the Roth IRA and just open a regular brokerage account with one of those apps and buy index funds or ETFs there. And if you're feeling adventurous and want to pick some individual stocks, put 80% in index funds and 20% in a couple of companies you believe in and understand. But please do your research first. Here's what I wish someone had told me when I was starting out. Investing isn't about getting rich quick. It's not about timing the market perfectly or finding the next hot stock. It's about time in the market, not timing the market. That $1,000 you invest today might not seem like much, but if you make investing a habit, if you keep adding to it month after month, year after year after year, that's when the magic happens. That's when compound interest turns small amounts into real wealth. I also want to address something that stops a lot of people: the fear of losing money. be scary headlines and red days and moments where you'll want to pull everything out. But here's the thing, if you're investing for the long term, those dips are actually opportunities. Some of the best times to invest have been right after market crashes because that's when everything is on sale. The worst thing you can do is panic and sell when the market drops. That's when you lock in losses. If you stay invested, history shows the market always recovers and goes higher over time. Let me leave you with 3 action steps you can take this week. First, decide on your timeline. Are you investing for 5 years from now, 10 years retirement? That answer will guide everything else. Second, open an account. Pick one of the platforms I mentioned. Fidelity, Vanguard, Schwab for traditional investing, or Robinhood or Webull if you want something simpler. The interface might feel confusing at first, but I promise it gets easier. Third, make your first investment, even if it's just $100 to start. Buy an index fund or ETF and watch what happens. You'll learn more from actually doing it than from watching 100 more videos. And remember, that first $1,000 is your foundation. Keep building on it, keep learning, keep showing up. Your future self will thank you for starting today. If this video helped you, hit that like button and drop a comment telling me what you're planning to invest in. Are you going with an index fund? A Roth era? I want to hear from you. And if you haven't subscribed yet, what are you waiting for? We drop new videos every Friday to help you build unstoppable financial freedom. Your money should work as hard as you do. Now go make it happen. I'll see you in the next one. Keep building that momentum.